Welcome everyone to today's webinar. My name is Spencer Harris, and I am a Vice President of Financing with Peak Hill Capital. Originally from Winnipeg, Manitoba, I'm now based in Kelowna, BC, and cover Western Canadian markets. For those of you new to Peak Hill Capital is an investment manager running funds for credit and equity throughout Canada and the United States. Our Canadian debt business is one of the largest CMHC lenders for term and construction, and we are also a conventional lender funding bridge and term on all asset classes. We will close over 800 loans this year, ranging from $1 million to $300 million, totaling over $6.5 billion this year. We also have a equity business focused on multifamily JV equity in development projects to help clients move projects forward. Today's webinar is a collaboration as we are joined by two industry experts and hear their thoughts on commercial real estate opportunities and market opportunities across the Canadian prairies. Capital Commercial Real Estate is a real estate brokerage property management firm specializing in retail, office, vacant land, industrial property sales and leasing, investment property sales, and property development consulting. Alongside Capital's principal owners, the brokerage operation is comprised of 15 licensed specialists who cover all asset classes. Capital's property management division is home to over 3.5 million square feet of commercial real estate, and their clients range from private owners to REITs, pension funds, and syndicated partnerships. Bryn Oliver joins us here today. He's based in Winnipeg and is a principal owner of Capital Commercial Real Estate. He also co-founded Capital Commercial Investment Services. Bryn has amassed a significant portfolio of transactional experience over the course of his career, and together with Capital Commercial Investment Services, Bryn and his team have generated well in excess of $1.5 billion in transaction volume and are recognized as one of the market leaders within the Canadian prairie landscape. Capital Commercial Investment Services is also strategically aligned with JLL on a national basis as part of their capital markets team. My esteemed colleague, Stephen Hart, is based in Calgary and Vice President of Financing for the Prairies market at Peak Hill Capital. He specializes in providing commercial and multifamily real estate debt financing for both institutional and private real estate companies. Steve has over 25 years of origination and lending experience and provides innovative financing solutions to his clients, including construction, bridge loans, and CMHC insured loans. I'd ask everyone to please ask your questions in the chat box at the bottom of the screen, and we will wait until the end of the conversation for the question and answer period. I'd like to welcome Bryn and Steve and start by having Bryn give us an investment market overview of each asset class in the Canadian prairies. We'll try to keep off this short unless they are conversions.
Sorry, it was muted. Hi, everyone. Thanks, Spencer and Steve, for having me join you today. I'm excited to be part of this webinar and share some insights into the prairie market. I guess first off, to get it out of the way, why don't we talk about office? The major story here are user owner groups like Manitoba Métis Federation and office conversion buyers like Alston Properties, who seem to be leading the charge in terms of transactions throughout the prairie markets. Not those groups specifically, but groups like them. Based on the transactions we've seen and been a party to, the repositioning sales, the pricings range from about $30 to $75 per square foot, while pure investment sales are showing cap rates from 9 to 11%. On this slide, the left two images show examples of user investment sales that were acquired by the Manitoba Métis Federation. These were significant announcements for downtown Winnipeg in terms of large amounts of vacant GLA being absorbed by the Manitoba Métis Federation. And the graphic on the right of your screen is the East Exchange portfolio that we're in the market with for Artis REIT. Target pricing here is in the the mid 8 cap range. And if anybody has any questions on that or the office market in general, they can reach out to me afterward. Moving on to a more attractive market, if you will, or segments of the market. Let's talk about industrial. Cap rates in this asset class have compressed throughout Calgary, Edmonton, and Winnipeg. And we've seen the same trend in Saskatchewan, but I've got less data points in that market to go off of. Calgary cap rates now reflect the low sixes, while Edmonton's are in the mid sixes, and Winnipeg's range from 6.75 to 7.5. And that, of course, depends on whether you're looking at small bay, large bay, or single tenant versus multi-tenant assets. On the screen here, we got an example on the left of a larger industrial asset that was principally occupied by Canada Goose. This asset sold earlier on in 2024 and was in the mid 7 cap range. The asset itself traded to a private group that entered Winnipeg through this acquisition, and they're out of Montreal. The image on the right is the CSSB portfolio we recently released. This is a portfolio of 4 small bay industrial assets. It's an offering the market hasn't seen for a while in terms of institutional quality, small bay industrial. The bid was well received, or the offering was well received with several bids, and we're under contract on it now. And we'll be able to tell you more about that transaction and how that compares to where we see market cap rates once we get a little further along. But it should end up flushing out in the low end of the cap rate range I previously talked about. Now moving on to retail. Overall, investment is down this year in terms of retail sales, and so are retail asking rents. Cap rates in Edmonton are up slightly to 7%, while Calgary's have improved to 6.5%, and Winnipeg cap rates reside slightly above 7%. Part of the reasoning behind the cap rate trends is in this asset class resides both not only in industrial rates, but also is impacted by which type of asset was sold in which market. As more enclosed shopping center sales dominate one market or another, we're going to see cap rates look like they've increased, but really it's due to the type of asset that was sold. On the screen, we've got Garden City Shopping Center that sold earlier this year to a group again from Eastern Canada out of Montreal that entered Winnipeg, and that sold for about a 7.25 cap. And then in the middle, or sorry, on the right side, we've got Johnson Terminal that again sold earlier this year to a group that entered Winnipeg again for the first time this year. That was a unique asset. It was retail and office located in the Forks in Winnipeg. And because of the office component, the cap rate entered up into the 8% range. And then in the middle is an asset we're in the market with for Fiera. We're currently under LOI and working through that transaction. Great. And last but not least, let's move on to the multifamily asset class. Investment volumes, generally speaking, here are also down slightly year over year. Calgary volumes were static. Calgary volumes were down slightly. Edmonton volumes were static, and Winnipeg volumes rose significantly. Winnipeg has proven to be quite robust in terms of value as investors seek real in-place yield. And then also they're coming into Winnipeg in pursuit of MLI Select financing because that program you can actually utilize to its maximum due to pricing and where rental rates are in Winnipeg. Cap rates in Winnipeg have remained consistent, and they trend in the low to mid 5s right now. They are down slightly in Edmonton and up slightly in Calgary, with both of those markets showing sub 6% cap rates. Some of the larger transactions did come out of the prairie markets this year in terms of the Canadian landscape. On this slide, on the left, we got Bison Point. That was a large concrete newer build asset our team sold earlier this year. It actually closed on June 24th, just before the capital gains changes took place. We didn't even have enough time to call for bids on that one. A buyer recognized the opportunity and came in with a very tight, quick closing, and we're able to win the day unexpectedly. I'm not sure if Spencer and Stephen can attest to this, but we did see some interesting activity earlier on in the year related to that capital gains change, though it didn't really dominate what occurred in the market. I'm sorry. And then the next asset we have in the middle here is Riverview Towers and Parkwood Square. We're currently in the market with that for Bearsman Management. The asking price for this portfolio is 144 million, and it's certainly an excellent opportunity to enter the Winnipeg market with scale. So if you have any questions or want to know any more about that particular opportunity, reach out to me offline. And then last on the right here, we've got the Hazelview portfolio. That was an asset we brought out to market earlier on in the year, and we're actually finally about to remove conditions. So more information on that significant transaction to follow.
Bryn, you mentioned the use of MLI Select. Obviously, here's some larger transactions. Have you seen an uptick in larger transactions in the last couple of years compared to?
Pardon me, in what transactions?
In just larger transactions. Have you seen an uptick
Yeah.
in the
So
last couple of
as
years?
the private buyers have now started to dominate the landscape in terms of the buyers buying multifamily, and it's really across all asset classes. Especially in multifamily, though, they've been able to really stretch and buy a lot of the larger institutional grade portfolios and assets, and that's primarily due to being able to achieve CMHC financing and really maximize the leverage that offers. And again, that's why we're seeing lots of the transaction volume come out of central Canada, including Winnipeg, because you go elsewhere into the larger markets like Vancouver and Toronto, which really I think these CMHC programs were made for, and they don't work as well. You can't get the leverage that you need, and so therefore, the private buyers are realizing that and moving their capital into the prairies.
Right. What else do you think there's any other reasons why, in general, that some of these other buyers from other markets in Montreal, like you said, have moved, whether in each asset class, to the prairies? If there's any sort of general attraction?
Stability and then in-place yield. Like that was a big story for a while as well, where cap rates haven't moved to really reflect the new interest rate environment for a long time. Whereas in the prairies, we never really got too pricey, and then we never really had to react too distinctively to the change in the interest rates. So, we were able to get deals done. The bid-ask spread was a lot closer, and vendors were not having to come too far off yesterday's pricing in order to transact.
Right. Yeah. Well, sounds a little different than my new hometown market of Kelowna.
Yeah, exactly.
Okay, well, you know what? Bit of a natural transition, talking about CMHC financing on some of these multifamily properties. Steve, what are you seeing in terms of multifamily in the different prairie markets, and how are some of those deals typically being financed?
Yeah, I mean, it's been a long stretch. The last 5 years have been something I've never experienced. It's just so condensed into multifamily finance. And I think, lenders are doing a very good job, and they know the programs really well, whether it's CMHC financing or non-CMHC financing, both construction and term of multifamily. But we are seeing that, multifamily isn't everything, and there is other asset classes. They all need loans, and we're seeing a return to that. And there's a bit of an experience gap, I think, at the moment. If you got into the industry and lending commercial real estate in the last 5 years, you've been overexposed to multifamily to lending and mainly CMHC. So there is a learning curve here that is happening right now that I'm seeing with my peers, my other lender friends that are starting to look at retail, office, and industrial that all need financing, and they just haven't been on that group of assets or focused on that group of assets until recently. With us at Peak Hill, we are all asset classes, all food groups of lending, and we're seeing that as well and ramping up training on making sure that we understand how to underwrite a retail mall, which is completely different than underwriting an apartment building. But lo and behold, still, and we're going on 5 years here, there is tons of multifamily lending available, and also lots of deals, buys and sells. The large investor has always predominantly in the past been buying the nice new product in apartments across the prairies, but and the smaller investor might be in that play where they want to find something small like a 12 or 15 suiter, put some money into it, remove some tenants, bring in others, increase the rents and add value that way. We do have a new group of small and mid-sized investors who are just looking at new and going, why wouldn't I buy that? I mean, that's something that'll last 70 years. Why would I go through all this work of creating wealth by buying low and improving and then having something worthwhile? So we're seeing new investors from across the country outside of the prairies coming and looking at the Alberta landscape or the Prairies landscape and seeing that we're very energetic and hopeful, and we have a decent economy. Calgary still remains one of the top probably 3 livable places in North America. And so with that, the small deals that we're seeing and lending on are these row houses and townhouses. They are financed very well through the CMHC MLI Select program, up to 95% and up to 50-year amortization. With that being said, it is investors, like I said before, from other parts of Canada. You could have an investor in Ontario who was thinking about getting into stocks and bonds for $300,000, but instead he's moving his investment into something alternative like commercial real estate, and the property is built or newly built out here in Calgary or Edmonton. So that's the landscape of financing at the moment. It is still predominantly apartments for most lenders, but it is moving back to the 4 food groups of office, retail, industrial, and apartments. And that's where it was, prior to maybe 2018. And that's what I'm seeing is the trend at the moment.
Absolutely.
Seeing,
couldn't agree more. Go ahead, Brent.
are you seeing buyers or borrowers, in your case, taking advantage of affordability and environmental, or is one outweighing the other in terms of generating MLI Select points?
Predominantly like 90%, what I'm seeing in the prairies here is affordability as the ways to get the required points for the MLI Select program. The energy efficiency, there has been some changes over the years, more so than the affordability program. So yeah, to answer the question, it is Alberta, like, I think it's over $1,700 per month per unit rent for Calgary. And that's you can qualify a lot of buildings in Alberta for that amount.
Well, that's what we're seeing a little bit more of a trend toward at least underwriting, with the idea of doing renovations in order to generate some of the energy point opportunities in Winnipeg, because right now CMHC still has 1,100 as the affordable rent, right? So that's pretty tough to commit long term to $1,100. So at least what I'm seeing is a little bit of a transition out of affordability and towards, or an emphasis, I should say, on energy.
Yeah. Yeah. And you won't see that out here. We're going to get into it in a bit about rent controls, but out here, 1775 per month unit Calgary is achievable. And we'd be in the same boat as you
Yeah.
in Winnipeg if we had rent control and a much lower. Did you say 1100?
Well, that's the CMHC affordable rent in our market. I hear it's supposed to go up, and maybe you guys can tell me, but
yeah, these are
that's on the horizon.
2019 numbers that they're using at the moment. We do hear that there's going to be changes to those numbers shortly.
Yeah, we should see a change shortly. Some of these outside investors from, Ontario and elsewhere that we're seeing, Steve, obviously most of the questions that come up are, why are they buying the properties? And I think along with that, obviously needing third-party management is a large one as well. So I know you're seeing lots of these sort of small to mid-sized deals of outside investors looking at anything from sixplexes and up, which are very common right now.
Yeah. Yeah. The international migration that we're experiencing in the Prairies has created such an opportunity, meaning more people coming, more people need a place to stay. They need a place to shop. They need a place to work in an office. This is something that we haven't seen before, and we don't see an end in sight, but we'll just keep building out here in the Prairies, and specifically Alberta and somewhat Saskatchewan and Manitoba, until the supply and demand takes effect here. We just don't have that. We have some political risk. We have some oil and gas economy risk, but it's good risk right now. It's acceptable risk. It's not something that is keeping these out of province investors away from Alberta. They're coming. They see this. We're in the part of the real estate cycle that they like, optimism and that, rather than, digging out of a tranche.
Absolutely. Okay, so transitioning slightly, Bryn, what are you seeing in terms of some trends you're seeing in multifamily in different markets? And is there anything you can provide some insight maybe in terms of like rent control and other things?
Well, again, building off what Steve mentioned, supply and demand, like I think some of the more recent government policy announcements in terms of immigration are already showing up, and kind of in my mind showing up a little faster than I would have expected in the multifamily market. We are seeing asking rents soften a little bit. We are seeing vacancy pop a little bit. Like, I mean, when I say pop, going up 0.5% or something from, super low to low, it's not problematic, but it certainly has shown up in the market. So there's a trend to pay attention to there, and then we'll see what impacts those policies have and how dramatic they are. In Manitoba, we're a little bit more stable in terms of our rental rate fluctuations, and that's largely due to government regulation of rents. We've got the residential tenancy branch here, and that has been in place for quite some time, and that's really stifled investment at times in building new multifamily, which is tempered the expansion of our rental universe. And in some cases that helps. It puts upward pressure on rents, but that upward pressure is it's hard to realize and turn into value when you've got rent restrictions. But every kind of government intervention into things like that naturally should be governed by supply and demand, create inefficiencies, and so our rent controls in Manitoba differ from those in BC, Ontario, and Quebec, in that the rent controls are tied to the suite and not tied to the tenant. So when your tenant leaves, you can't just market to market, which at surface that's a bad thing, but really and if you get to know the RTB and the processes within the RTB well, you can asset manage your way to a really good return here in Manitoba, and that's through above guideline increases. The current residential rent regulations allow for you to renovate your property and then raise rents beyond what the guideline increase is. And any year the guideline increase is determined by the government of Manitoba, and it could be either 1% or 3%, but usually it ends up being in and around 2% on average if you look over, say, a 5 or 10 year term. But in other markets, you don't have that opportunity to really and predictably asset manage your way to returns. Like, yes, you can mark your rents to market when a tenant leaves, but you can't really force increases, onto your rent roll like you can in Manitoba. When you renovate a handful of units and do CapEx, all of the units in the building get their rent increases, and you're guaranteed to get that increase next year. You don't have to wait for turnover. So, I guess there's good and bad, and everybody, doesn't like to have the big bad rentalsman breathing down their neck. But I think, it's a system that you can use to your advantage. Of course, you don't have that in Saskatchewan and Alberta, but you gotta go, you gotta take the pros and the cons of the free market out there. And, when everything's going up, so are you. And when vacancy is going up, you're feeling it as well. So, there, like I said, there's the good and the bad.
That's great. We can touch a little bit on what development looks like in the Prairies right now as well. Peak Hill has typically financed projects between $10 and $100 million across the country, and continue to do so in all major markets. We're definitely willing to go to some secondary markets as well on construction, and we work with developers of all size. There's definitely been a little bit of hesitation when there was rising interest rates and some projects were put on hold. But as interest rates have come back down, in markets where those projects were put on hold, they're coming back to life. Other markets like Kelowna haven't stopped. I know it's not the Prairies, but I see it day to day here, and definitely a little bit of changing dynamics. I'd say one thing that's also come to the forefront on the development side, especially in Alberta, is smaller developers looking at 6 and 8-plex projects where they can do it on a traditional single family lot. So when they're able to achieve some of these, between 85 and 95% financing through CMHC, it makes it much more doable for these smaller developers to get their financing and build out these smaller projects. So we're starting to help a bit with some of those, but generally still focused on the larger projects.
Yeah, certainly it's the developers we see. It's a buy and hold strategy rather than build and sell. Liquidity has come into play. All lenders look at liquidity before they advance funds to a borrower. Liquidity, what I mean is, say the project is a $30 million build of an apartment building, the lender probably is going to want about 10%, maybe $3 million in liquid assets. And of course, that's for risk of cost overruns, interest rate cost rising, but everyone thinks they're falling, but still you have to have a buffer. And timeline, like they thought they'd build it in 18 months. It actually took 24, and there's additional costs. So that liquidity is the key component. Whether it's a $3 million budget to build an apartment or a $30 million budget, the lender's number one thing is liquidity, and even monitoring that liquidity, say quarterly. Hey, you showed us that you had those liquid assets of $3 million in my example 6 months ago, but do you still have them, or did you go buy land? Because you need that cash available. So that's what I notice is a common theme with lenders is the liquidity required to approve new projects. And with that being said, the CMHC business, I would say in the Prairies here is probably half term, CMHC term where it is built, and the other half is new building. So there is new building still coming online. COIs are still getting issued, for new projects at, like you say, up to 95%. And costs sometimes go up, but I don't know if it's right or wrong, but with costs of construction going up, also rental rates have gone up. So it's kind of helped. It's helped the
Right.
developer for sure. If rental rates had gone down, there'd be a gap there that might not be solvable, but I guess it's been working out so far for the developer.
Well, in terms of development across the asset classes, some of the things I've seen, like we haven't seen a bunch of retail development. We've seen some industrial development, but absorption of that slowed down. Like overall in the industrial market, things have softened a little bit. Still very, very strong, very, very robust market to be in terms of buying and developing, but certainly not, strong enough to really see a lot of merchant development going on. We'll leave office alone in terms of development for obvious reasons, but we have seen quite a bit of merchant multifamily development. And to your point about rising construction costs, by the time the project's finished and the project's on the market for sale, a buyer can already buy below replacement costs, and the property just got their occupancy permit, so that's been a huge attraction, and why we've seen cap rates compress a little bit on that new build multifamily product, because you're able to basically buy, earn almost the same, or at the same or similar cap rate to a developer, but without that risk. And then the CMHC programs available allow you to get into these assets with very little equity and very little exposure to capex. So you put a good long-term 10-year CMHC financing in place, and you're able to stomach the risk of having a lot of leverage.
Yeah.
Fantastic. I hope everyone found Bryn and Steve's thoughts insightful. We do have a few minutes now for some questions. Got a few pulled up here. Maybe we'll start with Bryn. Someone's asking about multifamily market data. Are there good sources for market data, rental rates, vacancy rates, number of units under construction, et cetera? They said CMHC data is lacking and always out of date.
Well, one of the complaints I have out of Manitoba, at least, is we don't track the same way that things are tracked in Ontario and other markets. And again, I'm not as familiar in Alberta how you track some of these data points in terms of sales, but really you got to rely on your brokers and your appraisers and your mortgage brokers and your lenders to get that level of detail. Like, we track it all, but there isn't a centralized resource, at least coming out of Manitoba, where you can go and you can find exactly how many units were built year over year, how many building permits were pulled year over year, and things like that. But if you want to reach out to me, and if you've got any specific questions on the market and where things were, where they're going, and where they're at, feel free to.
I'm sure they'll come knocking. Another question here. What's the type of rental growth on rents in multifamily, retail, industrial you were seeing?
Retail rates have softened a little bit. Industrial rates, I mean, in Winnipeg specifically, they continue to rise on average. And I say on average because the discrepancy between in-place rental rates and the rent you need as a developer to build new product is substantial. And so tenants, so there's not as much product coming online in terms of new build, and tenants don't have a lot of choice in terms of where are they going to go, where are they going to move to. So landlords are able to really push rents, and so even though the market is somewhat softening, we're still seeing rental rate growth. And at one point in time, we were seeing renewals where you would renew for whatever it might be, a 5 or 10% bump, and then there was 3% bumps year over year after that. We're not seeing as much of that year over year rental rate or built-in bumps, if you will, in the renewals, but certainly decent growth. And then from I guess an office perspective, that speaks for itself, but from a multi-family perspective, between the guideline increase that you're allowed, and this year, unfortunately, it's only 1.7%, and then the average of what we see owners being able to achieve with the above guideline rental rate increases, like, you know, the rent, and then plus adding new product to the market, you know, we're seeing roughly on average 5 to kind of mid, or, you know, 5 to 7% rental rate growth, I would say.
Question for Steve here. Do you find that small multifamily rentals, let's say 6 to 10 units in the Prairies, qualify for the MLI Select program? They said because in Ontario, the numbers never seem to work under 15 units post-construction completion.
Yeah, I mean, I haven't seen many that don't qualify for MLI Select, somewhere between that 90 and 95% of purchase. They're small, they're, you know, they're not easy, but the same thought goes into a $3 million purchase of a newly constructed that it does into a $30 million constructed. But yeah, I wouldn't say that we're having the difficulties. I know what you're talking about, BC and Ontario. The numbers don't work near as good. Since 2020, the numbers have worked for Alberta. We have not had pushback. It's because the affordable per unit amount is higher here. Vacancy is I'm going to say lower. But then the surplus of new people that need new homes is definitely robust in the Prairies here, specifically Alberta.
Definitely. And obviously, you know, if the numbers aren't working out as well in BC and Ontario, that's part of the reason why it's attracting so many outside investors.
Yeah. And there is Brian, there is ways that we can do deals together. Like typically a person's going to come to you, an investor, and try to find a property first. They're not going to call their lender and say, what do I qualify for? But when you're out there in the front end finding the investor what they want in any asset class, we should have more synergies together where we look at the deal, we pre-screen the deal, we use our own, we have tons of resources, whether it's external resources that we subscribe to like CoStar or Altus, but internally, like we have to make a decision of what we think the value of the property is. Not even, and if it's multifamily, we also have to think what CMHC's value of the property is. But there should be more synergies up front between our office and yours, where we kind of give your buyer a pre-screen good attempt at saying this is what the lending is going to look like on this, no matter what the asset class. I think that's something that isn't being done right now. Lenders are being a little more reactive, but I think that would help a lot in the industry if lenders got into the process at an earlier stage when the client is thinking about buying, not so much the financing.
Absolutely.
Right on. I think there might be one more question here. Does Peak Hill like purchase plus improvements? Let's say a $1.5 million buy with a $1 million reno. What equity do they like upfront, then rolled into CMHC after?
That's something that's a whole other subject. That purchase plus improvement program. A lot of lenders were into it, and then they were not, because there was what's called warehousing concerns, and that's more than what this call is about. But the purchase plus improvement program, I have found lenders are less excited about it and less willing to support it, because they've had cases where the purchase was okay, but the improvements was supposed to take 6 months and it ended up taking 16 months. So that is a good question, but that's a call to Spencer or I, or anyone at Peak Hill.
Definitely. Okay, I think that's all the questions we have. Thanks everyone for tuning in to today's webinar. We have recorded the session and we'll distribute the recording in the coming days. Please reach out to Bryn with any investment inquiries, and for financing opportunities, definitely call Steve or myself.